Robust consumer activity in the United States dampened optimism about deflation, though the retail sales data did not drastically change the outlook for the Fed's agenda. The stock market has moderated its rally. The economic calendar for the United States contains a series of data that might clear the outlook for the Fed's interest rates. Besides, more U.S. retailers are due to report on their quarterly results. This will also shed light on consumer sentiment. The benchmark stock indexes closed yesterday in the green. The Dow Jones logged the biggest gain, and the S&P 500 and the Nasdaq closed almost flat. The S&P 500 inched up by 0.16% to close at 4,502 points. The major stock indexes went down in the New York pre-market. The fresh economic data lifted market sentiment. As for the intraday outlook of the S&P 500, the bulls find it hard to sustain the index above 4,500 points. The basic scenario suggests an intraday corridor between 4,476 and 4,520 points. The most optimistic scenario looks like a climb to 4,560. The most pessimistic one is a decline to 4,467. The US stock market closed with the modest gains yesterday, driven by the quarterly results of a Target. Its shares leapt by 17.8%, the fastest intraday growth since August 2019. The retailer provided profit estimates for the final quarter, which surpassed the Wall Street consensus. The upbeat forecast comes as a result of lower expenses in the supply chains. Good prospects of a Target pushed up shares of other retailers so that the consumer goods index in the S&P 500 was the best performer with a 8.7% increase. The factory inflation report showed on Wednesday the steepest fall in U.S. producer prices in October for the 3.5 years. In a separate report, retail sales looked less than expected decline. These two figures confirmed the likelihood that the Federal Reserve has been following a path to a soft landing. Market sentiment was also improved by the news from the House of Representatives, who passed a stopgap spending bill that would prevent the government shutdown with a broad support from lawmakers from both parties. The Senate and the House of Representatives have to pass the legislation until midnight Friday, and today futures on the stock indexes are trading lower as the optimism about the end of the Fed's rate hikes is ebbing away. Meanwhile, the market shared a weekly update on unemployment claims, and the U.S. Labor Department reported that initial jobless claims increased to 231,000 last week. It's the highest score for nearly 3 months, and the data indicates clearly sluggish hiring among U.S. employees. Investors could sign with a relief, but another report appeals to caution in predicting the future of the U.S. economy. The manufacturing index by the Philadelphia Fed remained on a negative territory at a minus 5.9 points in November, and the region is stronger than the expected minus 9 points. Still, it's the 16th negative score in the last 18 months. Forward-looking indicators signal that companies express moderate expectations for 6 months ahead. Market participants will be alert to new comments by Fed policymakers, including voting members, New York Fed President John Williams and Fed Vice Chair for Supervision Michael Barr. Although Fed officials have refused to completely rule out the possibility of another rate hike this cycle. San Francisco Fed Governor Mary Daly described the latest inflation picture as very encouraging. A headwind for the stock market today remains disappointment following the talks between U.S. President Joe Biden and China's leader Xi Jinping, which could put pressure on the technology sector. The US currency tried to recover its losses for the most part of the day. However, encouraging signs from the labor market dispelled dollar optimism. As a result, the US dollar index retreated to 104.10, having lost 0.2% down. The intraday outlook for the index remains the same. It's likely to trade between 104.10 and 104.40. The worst-case scenario means a decline to 103.80. The best-case scenario is a climb to 104.80. The greenback received a boost from the better-than-expected retail sales and could recover yesterday after 2 volatile days, but it lost bullish momentum shortly after following the report on an increase in unemployment claims, and the US dollar's weakness is evident in recent days. Traders are still confident that the Federal Reserve would not raise interest rates anymore. On the one hand, the market is aware of deflation. On the other hand, the US economy remains resilient. Thus, the available economic data is not enough to predict accurately when the US Fed will begin its monetary easing. The Canadian dollar is getting weaker today against its American rival. The USD CAD pair climbed by 0.27% to open the New York trade at 1.3714. The instrument is expected to trade in the intraday Canada between 1.3668 and 1.3746. Home sales in Canada went down, but this data is of a secondary importance. Besides, it has been already priced in by the market, so the market gave a minor response. All in all, the loonie is again sensitive to oil prices, which drag it down. Both oil benchmark rates shed almost 1% and stalled the looney's rally. The crypto market is riding with the sharp price swings. Bitcoin briefly approached the landmark level of 38,000 and steeply dropped to 36,860, so it instantly lost 2%. Yesterday, the crypto market took no notice of the news about another delay of the decision on a spot Bitcoin ETF. Today, there is important news, and the intraday outlook for Bitcoin suggests trading in the corridor between $36,800 and $37,250. The exit beyond the borders will either make the token retest 36,400 or enable its growth to $37,800. Feel free to leave your comments or ask any questions. We are open for your feedback. Subscribe to InstaForex TV channel and keep close tabs on financial markets. So see you online tomorrow.